Okay, good afternoon, ladies and gentlemen. Here we are. It's Paul. Here we are on Monday, 15th of October for what I believe is our 12th session of the Mastering the 4 M's of Trading Admiral Markets webinar series. For those who don't know me, my name is Paul Wallace. I'm a trader, analyst and coach, and I'm our guide through this Admiral Markets series where we discuss and I help educate you about how to go around mastering the 4 M's of trading. As always, I look to begin with a quick risk disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 83% of retail investor accounts lose money when trading CFDs with Admiral Markets UK. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please ensure you fully understand all risks involved. Forex and CFD trading is a risky activity, and this presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. This presentation and accompanying video is for information and educational purposes only. As of August 2018, the regulation within the European Union differs for retail and professional clients. In our presentation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from an unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payout of £50,000 sterling as per our negative balance protection policy. Why would you wish to trade with Admiral Markets UK? Well, you'll find that your account representative will be happy to talk to you and guide you through the many reasons to trade with Admiral Markets UK. But in terms of their offerings, their products and services, the DAX 30 has a typical spread of 0.8 points during the main trading hours, as does the euro dollar. They also provide both the MetaTrader 4 and MetaTrader 5 with the Admiral Markets Supreme Edition, which is a wonderful addition to those trading platforms. As always, as I say, you can contact your account representative and they'll be very happy to discuss the options with you. So for those who don't know me, as I said, my name is Paul Wallace. Okay, I consider myself to be a discretionary-based method trader, and primarily I'm a dominant trend swing trader. I'm very big on keeping things as simple as possible, and I look to meld fundamentals, technical sentiment, and geopolitics to give myself a decision-making framework. But primarily, I look at FX indices and commodities, and within certainly FX markets, I'm looking to buy strength and sell weakness. I will trade breakouts, but personally I prefer mostly pullbacks for my particular entries. And for intraday trading, which we'll cover much further down the path of this, is that I'm primarily a mean reversion trader for that. But that will become more apparent as we enter that arena later on in this particular series. As always, I'd like to set the expectations for our session. It's for me to educate you about the 4 M's of trading, so you can go away and analyze any market and be ready to trade any market, whichever, depending upon your personal preferences. And I'm also going around about helping raise your self-awareness about how you manage risk and also about you manage yourself. For yourselves, ladies and gentlemen, I appreciate I always have a broad range of experience in the room, that I have a time limitation of 45 minutes, and so that sometimes limits the breadth and depth of within which I can go into the topics. So I'm always trying to give you something that you can take away and use tomorrow in your trading. That's the whole idea, okay? So that you can actually take away a few of the ideas, the concepts, the thoughts that I share with you, and you can take away and use it tomorrow in your own trading. And that's the way I like to try and work. So, I'm sure some of you will have, if not sort of joined us, but may have seen the presentations here on the Admiral Markets YouTube channel or the Facebook page. And realistically, the whole sessions, the whole series is about mastering the 4 M's of trading. The 4 M's of trading is all about the markets, the method, the money, and myself. Because when they are all in alignment and when a trader is managing those 4 areas well, that tends to be a sort of a little bit of a sweet spot within which the trader tends to deliver good performance. So, on the sort of flip side of that, if you're having 1 or 2 challenges in your trading, okay, then give yourself a quick review about where you are in regards to those 4 M's of trading, and that might actually help you start to identify the challenges and where you can work on to sort of create your next evolution as a trader. So we've talked a lot about having a routine, about the importance of having processes, about actually how in terms of like the markets and the method side of it, having that kind of consistent approach is what helps us as traders. And every week I've been going through, as we've focused on the markets and method elements of the 4Ms. I've been going through what we have as in terms of a very, very simple routine to follow. Okay, so whenever we open a chart, we're looking to define levels of support resistance. Then we're looking to define if there's a trend. We're looking to see how price reacts at those key levels. We're looking for particular price action signals at those levels. And we'll be looking at is that part of a bigger chart pattern in the future. And what we've been focusing on for about the last 4 or 5 weeks is about particular the price action signals. Okay, and that's we've got this week and then one more week, and then we'll be moving on to sort of step 5. So that's what we've been doing. If you're joining us for the first time, is just actually building that kind of that routine, that process, good habits, good behaviors that you can help you become consistent in your approach to how you engage and interact with financial markets. So, what we're looking at, as I said, step 1, define levels of support and resistance. All right, look at monthly, weekly, and daily charts, draw in those horizontal levels of support resistance, and also any particular significant psychological round numbers. And we also talked, and I think it might have been in session 2 or session 3, about how you could also use fractals to help you define those particular levels as well. Then we were looking to, step 2, define the trend. Can you identify whether an instrument is trending or consolidating? That's very important for traders. Okay, and sometimes we lose track of that depending upon regardless of our experience. But it needs to be a very simple way to do it. Okay, I say it every week. Okay, a good trend leaps off the chart at you. All right, so if you're struggling to identify whether an instrument is in a trend, if you're struggling to identify that, well, I'll give you a hint: there is no trend. Okay. Good trends leap off the charts. All right, you can see when an instrument is consolidating, and then when it's breaking out and moving in a nice trend. Okay, and that's what we're looking to find. Okay, ideally to begin with, we're just looking at being like a dominant swing trader, and we're looking to sort of trade swings in existing trends where possible. We've also talked about in session about using moving average, and I have on my chart the blue 20 period, the red 50, and the green 200 period moving average. We don't use them for moving average crossovers as entry or exit signals, but what we are using them as an indication of the trend, the strength of the trend, the speed of the trend. Okay, and also they operate as effective areas of dynamic support and resistance. Then, as I said, we're waiting for how price reacts at those particular key levels, all right? And I talk about what does that mean. Every week I talk about we're looking for a confluence of events to happen at key levels. That's what we're looking for. We're looking for somewhere between like 2 to 4 things are going to happen at that time and place, and that is giving us an idea that that's where we want to do business. That's where we want to enter into a particular trade. And I say this every week as well. Okay, it's just that we keep it very simple to begin with. Markets are bullish, we want to be a buyer. When markets are bearish, we want to be a seller. We define the trend and we trade with it. No trade, no trade, no signal, no trade. And that's what we're actually looking at. Okay, we're just keeping it nice and simple. I quite often tell people, new traders that they should take a screenshot of that slide, stick it up on the wall in front of you. Okay, just to sometimes remind you. Okay, that because we all get excited, we all get a little bit impulsive, we all like to sort of trade something that when we open the chart, but actually what we need to do is just keep it very simple. Okay, have a little simple process. All right, just remind ourselves: markets are bullish, I want to be a buyer, and markets are bearish, I want to be a seller. All right, just sounds very simplistic, but actually the whole idea is to keep you on the right side. Okay, and that's actually all that matters. You just want to be on the right side of the market. So yeah, we've done the first 3 steps, and then, as I said, for the last sort of 5-6 weeks, we've been going through the sort of looking for price action signals, and we've gone through quite a few of them, and hopefully you've enjoyed me sharing those, all those different types that we've covered. Okay, as we've focused mostly on the markets and the method element of mastering the 4M. So as our sessions develop, okay, as the series prolongs and goes on, we'll be looking to look at money and myself, but I appreciate the last few weeks and stuff, and the next couple of weeks ahead we're still on this kind of markets and method elements of it. So if you're completely brand new to trading, all right, what I talked about is that of all the trading and investing styles that you can find out there, the majority of them break down into either it's a break of a line of support resistance or a bounce off a line of support resistance. It's as simple as that. We can try and complicate it as much as we want, and we do, and I am as guilty of that as anybody else. Okay, but what I've found is that the more I break these things down into just the simple concepts, the easier I'm able to understand it. The easier I'm able to understand it, the easier I'm actually able to execute it. Okay, that's the important thing, that I can basically have consistent execution every time. That's what I'm looking for. So some people like to trade breakouts, some people like to trade pullbacks or bounces. Okay, I know that when I look at my own trading records, primarily I prefer to trade bounces. Okay, and the reason being is I think I can get an entry at a better price, and also if I'm going to be wrong, I know far quicker, which is important to me. That's not to say breakouts can't be traded well, and I will do, and we're sharing one or two ideas where how to trade them in breakouts, and we'll look at that a little bit later on today. But it's you as you trade and as you start to analyze your own trading methods, you start to you start to discover and understand the patterns within your own trading, and that becomes very important. So, we've gone through, all right, and I've gone through, these very, very swiftly. What you can do is you can go to the Admiral Markets YouTube channel, okay, the Admiral Markets Facebook page, and that will actually provide you with say that you can basically look at those in depth. Okay, so I'm literally just going to fly through these as we go. Okay, so there's a little question there. Okay, from I think it was from was it Nigel? I think it's just asking that if I have a pullback trader, do I use fibs in this regard? And of a sort, Nigel. Okay, of a sort, and I will cover that in sort of greater depth in one of the future webinar episodes, should we call it episodes? We'll do it. We'll talk particularly about Fibonacci levels in terms of either A for pullbacks or B for particularly targets. So with what we're doing here, we don't necessarily really need Fibonacci, okay? But as we get into the later stages of mastering the 4Ms, as we get into the elements of a little bit more of the sort of advanced ideas, then I'll be sharing some of those kind of Fibonacci ideas with you as well. So, very quickly, as I said, pin bar, okay, rejection candle, a high test or a low test candle is very often it's described as, okay. So, very simple, all right, open and close within the previous bar, a candle with 2 to 3 times the length of the body. You like to see a long nose protruding from all the other bars, all right, and some of the better pin bars stick out and are very obvious, all right. And I'm sure that most of you will have seen pin bars on a chart before, okay. Then the good ones are very obvious and stick out. And what we talked about is effectively recognizing that they're likely indicators of where the biggest predators are lurking. Okay, when we see those wicks and those tails, it's like where big predators have been taking a bite out of the market. It shows rejection of a particular area or direction. And so as private traders, we're not going to fight that, okay? We're going to work with it to likely, work with them to sort of give us an idea where maybe the likely short-term direction could be. And that would be, if that's part of a pullback in an existing trend, that makes me even happier. So yeah, we looked at pin bars. We've looked at then we looked at engulfing candles the week after. Okay, an outside bar. It doesn't happen anywhere near as much as the as pin bar. Okay, they are less frequent, but they're very powerful when you see them at the end of a trend. Okay, and effectively the high and low of the bar entirely engulfs the range of the preceding bar. Okay, and when I say the high and low, I mean the actual high and low as well, the wicks. Okay, some people like to trade engulfing candles just off the main body. Personally, I like to sort of capture all of the range of that particular candle to define if it is a high and if it is an engulfing candle in particular. So as I said, it happens rarely, but high probability. It's a reversal pattern. So, I'm looking for a bullish engulfing candle at the end of a downtrend, or if I look for a bearish engulfing candle at the end of an uptrend, all right? And what we're looking to do is to trade in the direction of the close of the engulfing bar. That's it. Keep it simple. Then 1 week we talked in particular about a very simple 3-bar reversal setup, okay? Just almost like a very simple mechanical idea that you could take away and use in your own trading, okay? And about how to sort of a simple mechanical pullback trading setup. We look to define if there's a trend, wait for a pullback to support resistance levels, okay? And once we see price pull back to those support resistance levels, we're looking for a 3-bar reversal, and that 3-bar should be in an uptrend it should be 2 seller bars followed by a buyer bar, or if in a downtrend we're looking for 2 buyer bars followed by a seller bar. Very, very simplistic, okay? very simplistic mechanical reversal strategy. But sometimes for, as I said, for new traders, it's about, just taking a very simple mechanical idea and proving that you can trade it flawlessly for 20, 40, 60, 80, 100 trades, okay, because it'll give you great confidence to be able to just flawlessly execute a simple plan, and that will actually progress you to being a sound trader much faster than many other ideas. So what we talked about is, if the buyer bar or the seller bar, okay, and is something like a pin bar, an engulfing candle, or an inside bar, or something like a doji or spinning top, that actually gives us more confidence. You can see that example there, okay, on the chart. With it's an uptrend, price pulls back to the 20-period moving average. We have two seller bars, two red bars, followed by a green buyer bar, which is also a bullish pin bar. So it gives me a nice idea to get the trade on, okay, and we're joining the trend, okay. Simple mechanical 3-bar reversal strategy. Nothing too esoteric, just simple, and you can see what to do. And we talked about like trades here on the Aussie dollar, which was in a downtrend, okay. We can see that and that's the daily chart. There was quite a few examples over this summer, okay, of that effectively setting up like that. So yeah, so it was very simple, very something you take away. Okay, to find if there's a trend, wait for a pullback to support resistance. All right, for a long you need 2 seller bars followed by a buyer, and for a short you need 2 buyer bars followed by a seller. And I said to begin with, just to give yourself, if you're using targets, all right, just look for a very simple 1.5 to 1 reward to risk ratio for your trade, just to get the trader going and get you into following a simple trading setup. So then we did the inside bar a few weeks back, okay, all right. So whereas the engulfing bar, the high and low completely engulfs the range of the bar before, on an inside bar, the high and the low of the bar is fully within the range of the preceding bar, right? And I talk about this, it's like markets are like an organism, an organism breathing. Markets, they surge, they rest, and then they surge. The inside bar is, think of it like that's the rest, okay? The market surged, market may have a little pullback, okay, and a little bit of an inside bar. The market's resting, and it's getting ready for its next surge, and that's what we're looking to do. We're looking to try and catch that next surge, okay? Almost like a surfer trying to catch the next big wave, okay, in the market. That's what we're looking to do. So yeah, so there's examples of the inside bar there. Okay, as I said, the range of the high and the low should be within the bar, the bar preceding, sometimes called the mother bar. Okay, it should be well within it. All right, it's a rest before the next surge occurs, and that's what we're looking and waiting for. Yeah, and just examples, and as I said, we can use this as a as at the end of a pullback in a trend, but also as price breaks out to sort of a new direction or a new pattern, then sometimes the inside bar there after the breakout can give us an opportunity to get on board that new possible trend. So as I said, yeah, we look to preferably in a pullback in a trend, okay, we also talked about you can trade it on the break of the bar or break of the range based upon the size and the time frame that you're waiting for. As I said, they work mostly best in trending markets where it can be a continuation signal, okay, when it forms at a support and resistance level, so it can act as that kind of a stalling or a stopping signal of what's going on. But also, as I said, it can also work in good breakouts. Okay, you wait for the breakout to occur. As you can see there, the price broke the level to the south side, then you wait for an inside bar to be printed, and then you trade that in the direction of the breakout. Okay, and that might be what gives you your opportunity. So last week we talked about key day reversals and momentum reversal candles. All right, that's what we were looking at. Okay, so two quite similar setups. All right, and I say there that they're ideal for things like the for daily, weekly, and monthly charts. But like everything I talk about here, they are what I call time frame and instrument agnostic. Okay, namely that the ideas will work on any time frame and they will work on any particular instrument. That's what I like to share with traders. It's a little bit of a reverse strategy. So what we'd be looking for is ideally, to sort of reversal as part of a pullback in a trend. Best used for low risk, high reward opportunities. Okay, so after a big move in one direction, we're looking for momentum to reverse, and as always, we're more interested when that happens at particular key levels, and then we just use a particular setup, which is either like a key reversal or a momentum reversal candle. So a key day reversal, which you quite often hear me call it as KDR, it happens. A lot of people like to trade them off the daily chart, but actually you will see them across all time frames from 1 minute to monthly charts. So it's a sharp reversal pattern that occurs, at the end of a trend. In an uptrend, prices open, okay, or rise above the previous day's close. They make a new high, and price reverses during the session and closes below the previous day's low. So there's been a real, think about it, the psychology of the market has changed. In an uptrend, the bears have stepped in and have wrestled control of that market. In a downtrend, all right, price opens, below the previous day's close, makes a new low, and then closes higher than the previous day's high. It's had a complete reversal within that session, and now the bulls are in control. The greater the price range and volume, the key reversal day, the more reliable the signal is. So, there's an example of key day reversal. This is actually the monthly chart of Facebook. Hopefully, you can see that was in a really lovely big trend. And then what it would have been back sort of in June time was, you can see that, price basically pushed to new highs. Then effectively, it's completely reversed and collapsed and closed way beneath the low of the previous month. Let's just draw this in just to make sure it's clear. We can see that during that month, price pushed to all-time highs, but then actually it just collapsed. Okay, and we closed right down here near our lows. Okay, well beneath the low of the previous candle. And then what we've seen is that the next couple of months has just been a little bit of a move down. We had an inside bar there, okay, which we just talked about, and then also what we had is over the last couple of weeks is we've had a bit of a trend line break there as well. So there's 3 or 4 things all coming together to sort of just give us an indication that for the moment, okay, the move in Facebook is to the downside, all right? And that's, as I said, I'm showing you that on a monthly chart, but these things happen across all charts. It's about just being able to spend a bit of time practicing, being able to recognize them as swiftly as you can. So we talked about that's a key day reversal, but I also shared with you a momentum reversal candle, and what, if you remember, that is ideally we like to see key day reversals, but they don't happen as often as we like. However, a version of them that do appear more frequently, we'll call them kind of momentum reversal candles. So some people would call them swing candles. Okay, it's the name isn't necessarily the important thing. It's about you can recognize the actual pattern and work out how to utilize that for your own trading. So here if we're looking for a weekly or rather a long setup. Okay, so a bit like a key reversal. Okay, but price is in a downtrend and price makes a new low. But actually, price reverses, right? Price reverses during the session. Price makes a new low, okay. But during the session, okay, in a downtrend, price makes a new low. It actually comes up and it closes, okay. So it closes, okay, higher than the previous day's close, okay. Closes higher than the previous day's close. A key reversal would have to have closed up here. It might close higher than the previous day's high. But a momentum reversal is just an indication that it's closed higher than the previous day's close. Okay, so there has been a reversal momentum. It's not as strong as a key reversal, but it is still a strong signal when we see that in at the end of a significant trend. Okay, and that's something that we can work with. And we talked about here a few examples of how they can very often work together, and quite often you can see when a particular instrument is swinging nicely, as you can see there, that's oil. Okay, you can see that some of those swings were finished by either a key day reversal or a momentum reversal candle. Okay, and so when we see them, it's once again it's that confluence of events. That's what we were talking about, wanting to sort of keep abreast of. No, just more examples there, okay, in terms of gold, okay, daily, right, there's sort of swings on that, all being sort of driven and run and maneuvered by, or ended rather, by momentum reversal candles and KDRs. Okay, that's what actually we've been working on. So, what we talked about last week is, if KDRs and MLCs to provide an insight into the reversal of momentum, all right, and we can use that knowledge for a trade setup. Preferably, we combine it with levels and trend to build a confluence of events. In an ideal world, we like to see and trade key day reversals, but they don't happen as often as we'd like, all right. But the version of them that does happen a lot more is a momentum reversal candle, all right. So, basic trade is to buy the break of the candle, stop beneath the previous bar's low, And as I said, look to start to target, okay, sort of, I'd say, be saying about 1.5 to 1. As we go in deeper into these sessions, we'll be revisiting this and looking about how we can improve our reward to risk ratios to start sort of looking to generate 3, 4, 5, 6 plus reward to risk ratios. Okay, that's what we're looking. But to begin with, really a minimum like 1.5 to 1 reward to risk, just to basically allow you to sort of to do well on your winning trades. So there you go. Every week I go through a little bit of a go through this. Just adding the piece from the last week. The whole idea being that the more times you hear it from me, the more it sinks in, the more it becomes just your natural way of doing business. You're just being able to sort of follow that every single time. That's what we're particularly looking for. And what we're going to do here today is, I thought, just building off last week's work, is I'm going to do a little piece on a kind of a combo setup involving key reversals, but also the 1, 2, 3 pattern as well. And I'll show you how to use that. Okay, it's just as I say, every week, I'm just trying to build a little bit more into it every week by week, which allows you to, as I say, take these tools, techniques, and ideas and concepts, and use them tomorrow in your own trading. That's the whole raison d'etre, behind these sessions. Okay, sort of trying to educate you and help you, and then also allow you to provide you with ideas that you can go and take and work and use tomorrow in your own trading, ladies and gentlemen. So, what's this kind of like the 1, 2, 3 KDR combo, right? It's a discretionary method, all right? And what I mean by that is that I need to see a few things to happen for it to be a trade, okay, for me, and that's what takes a little bit of time and patience. I'm looking for the reversal that comes from a confluence of events. I'm never trying to pick an exact top, because I think that's a bit of a mugs game. Okay, lots of traders want to do that. They want to try and pick the exact top and bottom of the markets, but that is not as easy as people would like to make out. Okay, and when you see people on social media, sort of bragging and hollering about how they picked the top of the market, what they probably didn't tell you is the 9 times that they tried to pick the top of the market and failed. All right, so I'm never really trying to pick the exact top of a market. Okay, that's very difficult. Okay, and then it's not really a game to play. What I'm waiting to do is I'm waiting for the market to play its hand. That's what I'm waiting for. I'm waiting for the market to sort of show its hand, show what it's likely to do, and then that is what I'm going to utilize as a way and means to sort of to get my trade on. So this I use primarily on indices charts, but actually you'll find that it works across. So once again, it works across all instruments and all time frames, right? But I like to see it on indices charts, on kind of on the bigger time frames. Okay, but as I say, this you'll see these setups on 5-minute charts just as often, or probably if not more, than on the kind of longer time frame charts. All right. So what we've normally had is that price has probably been in a good trend. We've had just the standard 20, 50, 200 period moving averages just operating nicely. They've been in alignment. Okay, price has been doing its thing, working very nicely. And after a good trend, what happens is the first part is I take an interest when price prints like an individual reversal candle on maybe a daily and or a weekly chart. So that could be like a key reversal. It could be an engulfing pattern. It could be a pin bar or a rejection candle. Okay, it can be any of those. As when I start to see that, it starts to get me a little bit interested. So remember we talked last week. In terms of a key day reversal, all right. It can be formed in many ways, but actually it can also, key day reversal could also be a pin bar, an engulfing candle, or a combination of both, and that starts to get us very interested when we see that. Okay, so once I've seen price print that, then actually what I'm doing is I'm waiting for a 1, 2, 3 pattern to form. And that is going to help me provide a lower high, all right, which is a lower high, which is give me an idea, an indication that perhaps that uptrend is over and the trend is about to reverse. And you remember what I was saying just a few slides ago. I'm never trying to pick the exact top, because I think humans' ego loves to try and pick tops and bottoms, but the reality is it's not about feeding my ego. It's about feeding my trading account, okay? And I want to feed my trading account with profitable trades. And I have found for myself that when I don't try to pick exact tops and bottoms, my trading account grows healthier by the day. And so you learn that as a trader, okay, as an experienced trader, not to feed your ego, all right, but actually just to have simple plans that you can follow time and time again, okay? Because even in these days of algo-driven markets, the markets repeat, okay? Those patterns repeat, those setups repeat, and it becomes about having almost like a toolbox or a kit bag with a few setups that allow you to engage with the market when it sets up and gets ready to run in its in one of those repeatable patterns. So if you're completely new and you're not really sure what a 1, 2, 3 pattern is, okay, it's a very simple sort of a pattern that gives us an idea that a market is about to reverse, okay, that it's basically it's had enough, and it's here's a simple bearish 1, 2, 3 pattern is we have let's use our drawing tools, okay, so we've price forms a high, okay, we've probably been in an uptrend, okay. Price then rallies away or falls away. My apologies. And then as price reverses up, that forms 0.2 here. Okay, that forms 0.2. And then price it goes up. Tries to rally up, but it can't. It doesn't have the energy. It doesn't have the power to sort of to carry on with the trend. That's not working. Okay, so as I say every week. Please forgive my drawing. I'm a better trader than an artist. Okay, so I ask your forgiveness there. But what happens is price will get up and then effectively it will roll over and fall away. Okay, and so now what we have here is this is a called it's a 1, 2, 3 pattern. What it also does is that this gives us 0.3 should also be a lower high. So it's kind of just simple Dow theory. Okay, that we're the market is reversing, okay, and actually now what we're looking and expecting to do is to have a move to the downside, and that's what I'm looking to try and take advantage of. That's what I'm looking to try and play as a trader. So why is that 1, 2, 3 pattern important? Because what I look at it is it's the market providing sort of traders with a last chance to get on the party bus. Okay, it's that kind of last push up towards from 2 to 3. It's a last chance for people to get on the party bus here in the UK. They always used to say all aboard the Charabang, which was was like a kind of a party bus that would drive around taking people wherever they wanted to go, and that's what we're looking for in a trade. We want to get on board the party bus, namely when it's happening in an uptrend, we want to use that as an opportunity to sort of get on board as a seller and to sell at a good price. Remember what I was saying? I like particularly pullbacks. Okay, that's one of the things I like to sort of trade to allow me to get myself in at a better price, but also if I'm wrong, I get to know I'm wrong much swifter, and that works much better for myself. So here we go. So what we're looking for in the kind of third part is ideally what I want to see is I want to see that the sort of 0.3, okay, 0.3 of that 1, 2, 3 should be a rejection or an indecision candle, something like a pin, excuse me, an engulfing or a spinning top. So here we've got 1, 2, 3. Okay, the first part of it was, as you can see, there's a key day reversal, price pushed to a new high, but then closed beneath the 20-period moving average. Okay, it closed way beneath the lows of almost like the weeks trading beforehand. Okay, so we've already got a strong signal. Okay, that actually price is reversing at a particular level. Price comes down. It gives us there's some pin bars there. Okay, and price starts to rally up a bit. But what we can see is that as price got up here, it gave us a bearish rejection candle, okay, a bearish pin bar. So now we've got the 1, 2, 3 is in place. Okay, this is now a lower high. Okay, so it's now a lower high. So we're looking to expect to see the price sort of more likely to sort of move down over the over the next few sessions, and that's what I'm looking to be a player of. That's what I'm looking to be a part of. And ideally, it's an optional, but there's just like almost like a little trader's edge element for you from myself is, what I like to see, okay, or what makes me even happier is when I see the sort of the 20-period moving average, or whatever fast moving average you may particularly use, where it actually goes from acting as dynamic support to actually starting to become dynamic resistance. Hopefully, you can see that there. Okay, it's the blue 20-period moving average, and think of it as it's like a roof. Okay, it's capping this move to the upside. Okay, it's tried to push up, it can't get above it, can't hold any above it, and it's closing, and it's closing down beneath the lows of that, right? So I've got a KDR here, okay, then a 1-2-3 pattern, okay, 1-2-3 pattern, which is finishing with a rejection candle that is also being capped by the 20 period moving average. All right. Remember what I was saying earlier on. It's about looking for a confluence of events. All right. I'm looking for a confluence of events. That's what I'm interested in. And so there I've got 1, 2, 3, 4. I've got 4 elements there, all come together at one time and place. And for me, that's a trade. Okay, that's that's a trade for me. So yeah, here we go. So what I'm looking for is I'd be looking to trade the break of the candle at 0.3. Okay, stop loss above the highs. Okay, of 0.3. If it's close to 0.1, I might go above 0.1, but as a general rule, just above 0.3. I'm looking for at least a sort of a 2-to-1 target, or if you want to sort of trail, okay, I'd be using a tight, something like a 2-bar trailing stop. The reason being is that we're expecting quite a strong move to the downside, so we want to trail relatively close to be able to sort of enjoy some of that run down. So that's it's a very simple idea. Hopefully you can see how based upon what we have been talking about and covering the last few weeks, okay, in terms of key reversals, looking at kind of 1, 2, 3s, looking at how moving averages can act as dynamic support and resistance, okay, looking at sort of ends of trends or pullbacks, okay, and how we can sort of turn that to our particular advantage. And so yeah, this was a kind of an example here. This I think from not this summer, last summer. Okay, this is the Nasdaq. The Nasdaq. Let's get the pen on here. We can draw it a little bit here. So you can see price had been in an uptrend. Price got up to the kind of 5,900 area. Okay, which effectively put in a key day reversal there, which is the first sign that we were going to maybe drift down southways. Okay, price then as we looked in, price put in its 1, 2, 3. Okay. Which was then also the rejection candle, the pin bar, okay, capped by the 20, and actually we were able to sort of short the low of the bar and actually run it back down quite nicely towards back down towards those particular kind of levels down at sort of 5,639. So we had a nice trade there. Okay, we were sort of risking around about sort of kind of 30 handles for about kind of like for about what's that 40, 60, so 120. So we were risking about we were looking to get a good 2-to-1 trade out of that. Okay, even just a little bit more there. Okay, just looking at risking sort of 53 for 120 handles or so. Okay, so it's just nudging its way towards about 2.3R. Okay, on a trade basis. Well, just doing rough sums in my head, but hopefully you can see that was kind of that's what I'm kind of looking for, and I kind of like to see in my trading. At the same time, the Nasdaq did pretty much the same, okay, and this gave me actually a couple of opportunities. All right, we had the key day reversal there, okay. We then had it was a bit of a scruffy, okay, but we had a 1, 2, 3, okay, followed by forming that kind of a lower high that was with a rejection candle, okay. And then basically the price just dropped, okay, and it hit its target, and then actually it came back up and set itself again, okay, before it moved for a nice sort of 2-to-1 move, okay. So as I said, you need an element of patience, okay, but you're combining a few things to happen at one time and place to be able to sort of give yourself a trading opportunity. Okay, and as I said, we have, if you want to trade with a trailing bar stop, okay, I personally prefer to trade with a target, okay, but you can have a trade because you can actually see that the price it dropped nice a couple of times, but then actually it squeezed and actually went up and pushed up to new highs. Okay, so we're not trying to be, as I said, we're not trying to be trying to call exact tops, okay, but when we're seeing moves like that, we're just looking to utilize it to generate a little opportunity for ourselves. This was the Dow Jones, okay, the Dow Jones, okay, you can see lovely move upside, okay. We then had this is actually, it's not a KDR, but that's actually it's a momentum reversal candle, okay. Price then falls down, and and we can see it, it sort of bounces off that 20-period moving average. Okay, so we've got the 1, the 2, and price kind of works its way back up, and we get a rejection candle here. Okay, that actually sort of which breaks and moves us down back towards that down towards the sort of the 50-period moving average there. So once again we were risking about 40 points for about 100 points of profit. So it's about 2.5 to 1, okay, on a sort of a targeted thing, and that's a nice trade. I will happily take trades like that, all day long, okay, all day long. All right, so you might, as I said, you might particularly like to be trailing with your stop rather than targets. Okay, that's going to be a session we're going to touch on in a few weeks' time about which, when, and how to use it. So be sure to join us for that. But I personally tend to prefer to have targets in place for myself. And here's an interesting version of it, okay, just for us to finish up with. This was the US dollar index from last year. So on the monthly chart, okay, on the monthly chart here, let's get the pen up again. So on the monthly chart, we actually had, it's kind of a key reversal there, okay. A key reversal. It looks like it did, but it did close lower than that. So the first point is getting a key reversal at the start of the year, the start of the year, okay. Into 2017 last year, so we start to see that after what we'd had as quite a strong uptrend on the dollar index, and that was kind of interesting, because when we went down to the sort of the weekly chart, what we had that kind of 1, 2, 3 pattern there. We were also getting, it was just, as you can see, it was kind of hugging the 20-period moving average. We were getting rejection candles there. Okay, we were getting rejection candles before it, it rolled over and it fell away, and that actually became, an indicator for a much bigger sort of trade for us last year, because invariably, those of you who join me on the real-time daily trading ideas every Tuesday morning at 10 o'clock London time, you'll realize, I always take a look at the dollar index charts. If you trade FX markets, you want to know, whether the dollar is in a trend or whether it's moving strongly, and so what we had for the first half of last year was a real indication that of dollar weakness. So not only was that a big trade for us there in terms of the monthly and weekly charts, but we were able to utilize that in terms of how we traded the dollar against the other major currencies. So it gave us insight and opportunity on many levels. So as I said, it's just it's a simple combo based upon what we've been talking about. Okay, so understanding when we see big key reversals, right? Okay, seeing a simple 1, 2, 3 pattern, seeing preferably something like the fast or the 20-period moving average acting, turning from dynamic support to dynamic resistance for a downtrend. That 0.3 being something nice like a rejection candle, or another key reversal or momentum reversal, or an engulfing candle. Okay, so it's just trying to show you how you can have that confluence of events. You can have all of those things coming together in one place, sort of try and help give you a trading idea, and that's what we are looking at in particular. So, ladies and gentlemen, there we go, and what we're talking about, and we as we do less of the kind of the slides and more of actually looking at the charts. Okay, as I've passed on education to you, what we're looking at is talk to people about start to build a little profile, little portfolio, okay, of in terms of what to look at. So we look at these 28 FX major pairs, okay, the dollar index, and then 28 pairs, okay, from the sort of the inter market dynamics there between sterling, euro, Swiss franc, okay, Japanese yen, Aussie dollar, Kiwi dollar, and Canadian dollar, okay, and all against the US dollar. All right, now that gives us 28 FX pairs for us to have a look at. We'll also have a little look at the indices, okay, the major ones: S&P, Dow, Nas, FTSE, the DAX, the Nikkei. Looking at some of the commodities, mostly the hards, all right, so oil, gold, silver, and copper. But you can also look at the soft agri ones if that's of interest to you. Looking at some of the interesting equities, okay, that are out there. There's been some pretty interesting moves there, and then also we've also had a little bit of look at some of the cryptocurrencies, okay, which are offered by Admiral Markets now, things like Bitcoin, Ethereum, Litecoin, and Ripple, etc. So we say just to add those to things, we're going to be looking at them and building up a little bit of a profile and a portfolio of them for our forums of trading. So as always, remember to manage those four M's of trading, ladies and gentlemen: markets, methods, money, and myself. All right, are they all in alignment for yourself? All right, are they? If they're not, well then that might be why you're struggling. Okay, so you want to just monitor those four areas and just make sure that you're on top of them, you're mastering them, and that you're constantly learning and developing in those areas. As always, if you have any questions about either what we talked about, or want a little particular interest on Admiral Markets itself by excuse me, you want to have a little conversation with Admiral Markets about their products and services. Sorry, it's been a long day already. Then by all means, please get in touch with the account representative. They'll be very, very happy to talk with you. Okay, so you can contact that on the London number 020-7726-4003. Email them there, hello@admiralmarkets.com. Okay. YouTube, okay, as I said, they've got a YouTube page, Admiral Markets, okay. Most of these these videos will be on there. By all means, if there's one or two of the parts we've touched on today I've not been able to go through, well then go back and look at those, the previous sessions, because I go into the particular setups in more detail. And as always, you'll find Admiral Markets Global is also on the Facebook page. So there's lots of opportunities to interact with Admiral Markets there. And as I say, please feel free to get in touch with your account representative. They'll be very happy to sort of give you some conversation and guidance. So we've got a couple of minutes left. So should we have a little look at let's have a little look at some of those charts there. Okay, just one or two, just to finish off the last moment or two. Okay, so thanks for the questions. Okay, so that's very kind of you. Nigel says great. Thanks, Paul. Admiral Markets best presenter by far. That's very kind of you to say, Nigel. That's very kind of you to say. To be fair, Admiral Markets they've got a wide range of presenters from all the areas of kind of expertise and levels and stuff. So we all complement each other very very nicely. But that's very kind of you to say. Thank you. Thank you. So here we go. Let's have a little. Should we have a little look at the Dow here? Okay, because it was a bit of an interesting week last week, wasn't it? I'm going to be touching more on this tomorrow at the real-time daily trading ideas, 10 o'clock London time. You try and join me there or watch it afterwards. I have my own kind of Facebook page, and I talked about these. I put some slides up about what had happened last week, and what we can see there is, you can see it's just rolled off the top there, hasn't it, on the sort of the Dow daily. It fell down to the 200 period moving average there, okay, and as I was saying, what I was looking at is if we look here, this is the 20 period moving average, which was acting as dynamic support again, and it still was a little bit there last week. And I thought we might actually have a little bit of a bump up, back up to around about that 26,700, okay, before it rolled over. I was already getting ready. Those of you who joined me last Tuesday, the session, as to what I was talking about, but actually it wasn't happening, and it rolled and it collapsed there, and we've got that the 200 period has acted as some very nice support there, okay. And personally, I'm going to be interested to see, do we just this week just go sideways a little bit? I'm kind of intrigued to see, are we getting a little bit of a sort of a triangle building up here? Let's sort of draw this on here, right? So are we, maybe I might sort of be looking at that. Is that a little bit of coil building? Okay, I'll talk about that. We're going to go on to triangles, okay, when we go on to looking at bigger chart patterns. But I'm just be looking at that now to see, whether that would happen. And in terms of what we've just discussed, well, what I'll be looking to see is, well, could we actually get a move up here? Okay, back up to around about, what's that, about 26,300? That would give us maybe a 1, 2, 3 pattern there. And then if I got some bearish candles there, some bearish reversal candles there, then that might be a little trade for me to roll over to as well. We've also just seen, I'm going to touch on this tomorrow, okay, we just saw a spike there on Bitcoin, okay, so I was expecting us to have a little bit of a squeeze to the downside, but we've actually had a little bit of a squeeze to the upside. I'm just I'm just watching that, okay, and this is once again a bigger chart pattern. This is part 5 of the series that we'll be going on to in terms of moving from individual price action signals to looking to bigger chart patterns, okay. So this has been a big descending triangle, and we've I was expecting maybe a little bit of a 6,000 has acted as that kind of significant psychological number, and it's actually moved down there, and we've seen a little bit of a spike there, okay, above it. So I'm kind of curious to see why that's happened, and I'm sure that will all play out over the next few days and trading sessions. So there you go, ladies and gentlemen. I hope you found that useful. As always, I wish you the very best of success in your own trading endeavours. As I say, Tuesday morning, 10 o'clock is the London time, is real-time daily trading ideas. You're very welcome to join me. If not, then I look forward to sort of hopefully you'll join me next Monday, 4 o'clock for the next insight into the mastering the four M's of trading. Thank you for joining me. Okay, thank you for your questions and your comment and feedback. That's very kind of you. Thank you very much. And I look forward to speaking to you soon. Thanks very much, guys.